Hello, good day. My name is Dr. Abdul Adamu. This is our study session 4 on ratio analysis for the course Introduction to Finance. The learning outcome for this course: at the end of the course, students should be able to define ratio analysis, be able to compute the different ratios, including liquidity ratios, profitability ratios, leverage ratios, turnover ratios, and market value ratios. A ratio analysis is a technique used to evaluate companies' financial performance by comparing various financial statement items. So for ratio analysis, you take different items on the financial statement, you compare them to know whether the firm is doing well in one item relative to the other item. It involves calculating various ratios from data found on companies' financial statement, such as balance sheet and income statement. And when you take this data computation, you compare them to similar ratios for other companies in the industry, so that you'll be able to compare the performance of the company against other companies in the industry, or better still, to be able to compare the company's historical performance over time. So when you do have ratios for the last 3 years and you compare against the recent ratio, you should be able to know whether the firm is performing relative to the previous year or performing better than the previous years. We have different classifications of ratios, different classes of ratios. The best classification are these 5. We have liquidity ratios, profitability ratios, leverage or solvency ratios, turnover or efficiency ratios, and finally the market value ratios. We'll look at them one after the other. For liquidity ratios, they measure the ability of the firms to meet their short-term financial obligation. Like we say, liquidity, whether the firm is liquid or not. So that is why most of the things we use in liquidity ratio are from the current assets and current liability. We have so many types of liquidity ratio, but the most common one are the current ratio, the quick or acid test ratio, and the cash ratio. So for current ratio, you will use it. We do it by comparing the current assets and the current liability. Mind you, current assets are assets that the firm use within a year, while current liability are liability that the firm must meet within a year. So that is why for liquidity, we normally meet our current obligation from the current asset. So for current ratio, we compare current assets all over current liability. So the formula is current asset all over current liability. So if the current asset is higher than the current liability, then it means the current ratio is good. If it is lower, it means the company has no current asset to meet their current liability. So in most cases, current ratio must be 1 or greater. Then we have the quick ratio. The quick ratio is also known as the acid test ratio. Among the current assets, the most illiquid among them is the inventory. So for quick asset ratio, we remove inventory from the current asset before we compare it with current liability. So that is why we say it is like current ratio, but it excludes inventory from current asset because it is less liquid than cash and other cash equivalent. So it is calculated when you divide the current asset minus inventory all over the current liability. So the second type of ratio is the profitability ratio. That is, it measures the company's ability to generate profits and return on investment. We have so many types of them. We have the gross profit margin ratio, operating margin ratio, net profit margin ratio, return on assets, and return on equity. We'll look at some of them. The gross profit margin, this measures the company profitability by comparing the gross profit. Gross profit is the profit before tax. So they compare it with the revenue. I would say the highest revenue to every firm is the sales. So that is why gross profit margin is computed. When you take the gross profit, you just divide it by sales. So the higher, the better. The higher gross profit margin, the better. Then we have return on asset. For return on asset, it measures the company's profitability by comparing the net profit. The net profit is the net income, that is the profit after tax, by the total asset. So we divide the net profit by the total asset. Then we have the return on equity, which measures the company profitability by comparing its net profit to shareholders' equity. So you can see, because it's a return on equity, the denominator is shareholders' equity. So you divide the net income or net profit by the shareholders' equity. The higher, the better, since it's a measure of profitability. So the third type of ratio is the leverage ratio, which measures the company's ability to meet their long-term obligation. So it is also called debt ratio. So they include total debt ratio, debt to equity ratio, debt to asset ratio, the interest coverage ratio. So let's look at some of them. The total debt ratio measures is used to assess the total amount of debt a business has relative to their total asset. The total debt relative to total asset. So that is why when you are computing it, you divide your total debt by the total asset. So the total debt include both the short-term, the long-term debt, and the current liability. They form the total debt. So you divide it by the total asset. So the lower, the better. If it is high, it means the company is highly levered. Then we have the interest coverage ratio, which is used to assess the ability of the firm to pay their interest expenses on outstanding debt. You know, when you get debt, you have to service the debt and you pay interest on it. So, and these interests are normally paid from the earning before interest and tax, which we call gross profit. So interest coverage ratio is found by dividing the gross profit or earning before interest and tax by the interest expenses. All this information for computation, they are available in the financial statement, which include income statement and the balance sheet. Another type of leverage ratio is debt to equity ratio, which is used to assess the relative amount of debt and equity used to finance the company asset. So the total debt, you divide it by the total shareholders' equity. The fourth one is the turnover ratio, which measures how efficient the company is using their assets to manage their operation. So they include inventory turnover ratio, account receivable turnover ratio, and the sales outstanding ratio. So some of it, the asset turnover ratio measures how efficiently the company is using their asset to generate revenue. When we calculate it using sales divided by the total asset, the sales is the highest turnover, we divide it by the total asset. Then the inventory turnover ratio, we measures how efficiently the company is managing their inventory by comparing the cost of goods sold to its average inventory. So average inventory, divide the inventory by 2, and it is calculated as cost of goods sold all over the average inventory. And finally, the days sales outstanding measures the average number of days it takes for a company to collect its account receivable. When firm sells items on credit, it is important for them to get back their money from the debtors. So the average number of days it takes for them to collect it is a measure of turnover. So what you do is the account receivable, you divide it by sales and multiply it by 365, and the answer comes in days. And finally, we have the market value ratio, which is the fifth classification. The measure the relative value in stock, market, and the ability to generate wealth to shareholder. The other ratios I mentioned, the four I mentioned earlier, they are normally computed using the financial statement provided by the firm. So the market value normally take into cognizance the sentiment of the investor, the sentiment of the market. So that is why we normally use the market information. So we calculate we have different type. We have dividend yield, and the dividend we have first the price earning ratio, which measures the market expectation of a company's future earning by comparing the current market price per share to the earning per share. So the market price per share, you can see this from the stock market, how much the share price. Then you divide it by the earning per share. So the earning per share is the net income of the company. You divide it by the total share outstanding. So you need it to be able to calculate the price earning ratio. The higher, the better. Then we have the dividend yield, which is measure the amount of cash dividend payout to shareholders relative to the market price. You can see you compare the dividend in relation to the market price of the share. So annual dividend per share all over the market price per share. And we have the market capitalization, which measures the market value of the company. When you want to know how big the company is, we normally use the market capitalization, and it is computed by multiplying the number of outstanding share times the market price per share. So this is the market value ratio and the total sum of the ratio analysis. Thank you for listening.